Hello, I'm Ayako Yasuda. I'm at the University of California at Davis, and I'm going to talk to you about doing research in private equity and venture capital, as Ingrid said. So this is my overall message. Private equity and venture capital have gone mainstream, both as an industry and asset class, as well as a research area in the last couple of decades. It used to be an area where data access was quite challenging because by definition, you don't have these public data that's widely available. And that was a bit of a hurdle for doing high quality research. But the data access has improved very significantly, and so has publication opportunity. But at the same time, because it's a nascent field, there are still many unanswered questions. And there is a real upside for people with creativity and originality that can bring a lot of additional value to the existing literature. So in a nutshell, I think this is a very rewarding research area for young scholars just as yourself. So just to be on the same page about private equity, so private equity is primarily organized as a limited partnership. So PE firm like Blackstone will raise a fund from a bunch of institutional investors as well as some of the wealth clients. So let's say CalPERS, which is a California pension fund, invests in Blackstone private equity fund. Blackstone then searches for companies to acquire, and once the companies are identified, they ask the investors to provide the capital and then hold these companies privately held for several years, 3 to 5 years, with the goal of appreciation of the value of the company and eventual exit through either IPO or sale of the company, and the capital and the profits of the investments then recycle back to the investors. So that in a nutshell is the private equity investment. I started doing research in private equity back in 2007. And around that time, I remember presenting my first major paper in this area at the NVER, and I used this magazine cover because this was a bit of an epoch-making year for private equity when major PE firms decided to go public. And this picture is the picture of Steve Schwarzman, who heads Blackstone, and he was sort of hailed as the new king of Wall Street. At the time, I felt there were 3 main factors that motivated doing academic research in private equity and venture capital. PE back then was already a very significant player and as significant asset owners. They were involved in as much as 25–30% of all M&A transactions at the time, so that was definitely being noticed. At the same time, PE industry is notoriously opaque, and we don't understand a lot of what's going on behind the veil. And partly due to that data limitation, there was a relative dearth of high-quality academic research in this area. So all these 3 factors contribute to heightened value of high-quality academic research in the area, or so I thought. But this third factor, dearth of academic research, is sort of a double-edged sword, because at that time, it was indeed a more smaller niche research area. So I did an econ search on the number of top 6 finance journals, so that's the top 3 plus JFQA, Review of Finance and Management Science. And as of 2007, yes, there were smutterings of top papers in venture capital and LBOs from the late 80s, but let's just use mutual funds as a reference point. Mutual funds was a much bigger research area. Okay. 2007 was also the time, as with the hindsight, was just a year before the full-blown crisis began. And that was also the title of the Economist cover at the time. So since then, yes, private equity took a dive, just as the rest of the economy in the market, and then built back up, almost now at the level of the pre-crisis level in the amount of capital raised. And what is the share of the global economy of private equity? To get at that, I need to talk about the private equity as part of the alternative assets. So private equity is part of alternative assets. Hedge funds is another big part of it. It also includes real estate and infrastructure. So private equity is approximately 1/3 to 1/2 of alternative assets under management, let's say. So this this chart comes from BCG Report, and according to their tally, this is all equity, but alternatives comprises about 15% of the assets under management. So all the rest of it is public equity, and you can see passive, active core, specialties. The 85% is public equity. About 15% is now alternatives. And 41% of management fee revenues, because private equity and alternatives charge much higher fees. So using that 1/3, 1/2 share of PE within alternatives, we are talking about 5 to 7% of assets under management of the global asset management industry is now private equity. And about 15% of the fee revenues, and this is not including performance fees, is private equity. So this is now a major segment of the global asset management. I would say this is no longer a niche area. And and the forecast is that it's only expected to grow. As the share of the private equity in global economy rose, so has the publication opportunities. So as you can see, since 2007, we see a bit of an explosion of publications on private equity and venture capital in the top finance journals. And again, using mutual funds as sort of a reference point, you can see that in the last 5 years or so, now we have similar flow of top quality academic research coming out focused on these topics. But if you just look at the cumulative stock of academic knowledge, this is still a much lower, smaller stock. So there's much more to be added to the field. Sort of my point of this chart. So those 3 motivating factors that were there when I started doing research in private equity are still valid today. It's even the more significant asset owners of the economy today. It's still pretty opaque, and there's a whole lot that we don't understand about the economic workings of private equity. And we have more flow, but still an overall smaller stock of research in this area. So how do you contribute? If you are a researcher, how do you contribute to this field? I can identify several ways or angles or strategy or whatever you call it to contribute to this area. Because it is a relatively new area, you can ask a new question that hasn't been addressed. So that's a sort of an easy lower hanging fruit to add significantly to the literature. Because data limitations are very severe in this area with no public trading volumes and no such data available, there is a lot of value to be added with novel data that allows us to answer a question that wasn't possible before. So you can be very creative here to either discover, build, or synthesize novel data that allows us to have new insights about the private equity. There's also much room for methodological sophistication, again, to overcome the data limitation. A lot of the data are not only publicly unavailable, but simply unobservable. So how do you get around that? Econometricians have a lot to offer here, and there's some progress that's been made. I'm going to use an example to talk about. You can have a cool identification for exogenous variation. That's just as in the rest of the corporate finance, this is a significant way in which people contribute to this area. And finally, sort of interdisciplinary approach, I think, is very fertile in this area. And we're starting to see labor and finance, accounting, law and finance, politics, those sort of interdisciplinary papers starting to come out. I think that's a very fruitful direction to enrich our understanding of private equity and venture capital. As I mentioned, in the early days, data was a major issue. You either had to have a special access to a vendor source data that's very, very expensive and there's no academic discount, so most academic researchers would not be able to get hands on such data. Or, even more difficult, you have to use a proprietary data with special source, anonymous source of data provider. So unless you have those special connections, you couldn't simply go to CompuStat and write private equity papers. So that sort of made it more exclusive, perhaps higher entry cost. A lot has improved since then, so now there are more and more conventional data vendors that offer academic discounts. So for several $1,000s, you could subscribe to a very valuable set of data to start using these data. And if you team up with co-authors to pool resources, that has become much more like the rest of the finance research. Proprietary data are still very valuable, I don't deny it, so if you can use it by all means, that's a very good source of data. New exciting efforts have been made, at least two that I'm aware of, and Professor Kong had already mentioned one of them. So there are two data consortiums that are making data available just for academic researchers. The one is the Private Equity Research Consortium based at the University of North Carolina, Chapel Hill, and they use the data from a data provider called Burgess. I am currently using their data, and it's a very robust academic quality data where you request data, you submit data proposals, and if you are approved, you can use the data, but you're not going to actually get your hands on the data. So it's much like how you access the census data, but you can access this for free. There is a parallel consortium called Private Capital Research Institute that also is motivated similarly. So it's in a secure location, and then you access it through the data council who approves your data proposals. Performance data have been made available this way, and now we are starting to be able to have more of a portfolio company level data, even contract level data, state filings data that used to be very difficult to access. But now they have some new grants that are just being used to code up. So this is a very exciting time because more and more data are available freely and more equally among all researchers. So I would definitely take advantage of that going forward. There's much room for methodological contribution in this area, so econometricians can do a lot. We have existing framework that could be improved. In alpha and beta, measurements are notoriously difficult. Risk measurements is really, truly difficult. Adjusting for leverage is difficult. So there have been some progress we've made, but there's a lot more that we can do. Illiquidity premium, everybody can agree, it's very important, but we are not at a level where our research has saturated everything about it, so there's more that we can do. We can also introduce new framework to this area to make contributions. So a couple of papers, a couple of people, including some of my work, have used risk neutral valuation to get around some of the data absorbability problem. Others have used a model that's really, really commonly used in other areas, other fields in economics, like random effects model, but bring it to the private equity for the specific purpose of disentangling some of the effects that we couldn't disentangle before. So I'm going to use two examples in the limited time we have to illustrate how recent papers have advanced the literature by tackling some of these problems. So the first one with Mara and Hu Qin, Politically Connected Private Equity and Employment, 2017 JF paper. They tackled the questions of what happens to employment at portfolio company level after the private equity takes them over. This is a controversial question. there has been so far sort of mixed evidence in the academia. They find that, yes, they destroy jobs at the plants that get sort of cut back, but they also add jobs faster at a newly created plant. So overall, evidence is modest at best and mixed. But there is this perception that persists that, well, private equity is improving operational efficiency, so naturally jobs will be cut as a result. And so what they do, Mara and her co-author, they ask a new question, different question, and essentially, well, are PE firms heterogeneous in what they do with respect to employment? Could it be that the politically connected firms will act differently than non-politically connected firms? And they had that hypothesis because they have worked extensively with firms and political connection, looking at other firms, public firms, as well as private family-owned firms, etc. So they code PE firms as politically connected if an important member of the firm has been high-level political official or has worked for one. So, for example, in their sample is Kenneth Melman at KKR, who is a former chair of the Republican National Committee and has worked as a Bush campaign manager for election. And they do this arduously for a lot of individuals who work at private equity firms. And what they find is that jobs actually increase faster at politically connected PE portfolio companies. And these effects are stronger in election years and in states with higher level of corruption, and also provide evidence that the PE firms seem to get something in return, mostly through government contracts and procurements. So this is, why am I excited about this line of research? It identifies, first of all, a new source of rent for private equity. Private equity seems to deliver performance. Investors have been increasing allocation into this asset class, but we don't know exactly what the sources of their rent are. And so identify one, and beyond the sort of media anecdotes coverage, this is the first systematic study that shows that some PE profits from favorable political treatment. That is sort of their sustainable comparative advantage. To do this research, they combined employment data at the plant level, it's called NETS data, with the private equity deal data. And I know from my own experience how difficult that sort of data work is for private companies. For one, company names, there's no QSIPs. You have to match by company name. Company names don't stay the same. A lot of the times names change after LBO. So it's crazy, messy data work. So kudos to the authors who have done this to bring us these new insights. And more broadly speaking, I think political economy angle on private equity and venture capital is a new growth area of inquiry. I'm very excited to see more papers come out. A second paper, quite different in focus, is called Skill and Luck in Private Equity Performance by Korteweg and Sorensen, 2017 JFE. So Arthur and Morton ask, is there investable performance persistence in private equity? So we have known for more than a decade, since 2005 JF paper, Kaplan and Shore, that there is stronger performance persistence in private equity than in many, many other asset classes. And it's sort of a startling result. It's basically an autocorrelation of performance across fund N and fund N+1 run by the same fund manager. And that obviously excites investors. And that's a talking point for a lot of the fund managers in private equity. But what they ask is, well, does that mean that the investors can actually identify managers with higher expected returns and successfully invest in this performance persistence at the time they are making decisions? And that's not obvious. Private equity funds are illiquid, they are closed-end, and secondary markets are not very active. So you have to invest in fund N plus 1 when fund N is still ongoing. We don't know the final performance of the fund until the end of fund's life. So you are making an investment decision. The only time you can invest in your fund is when you only have imperfect information about the track record of the fund manager. So can LPs identify managers with higher expected return? To answer that question, they analyze this is a hierarchical linear model, or another name is variance decomposition model of PE performance, so that they can tease out 3 different types of persistence. One is the long run persistence we just talked about. So there is skill. Some firm managers are more skilled, so skill firms generate higher expected returns. There's investable persistence. That's what really matters to the investors. And for that to be present, noise from luck cannot be too large. And then there is a third problematic persistence in private equity that's pretty unique to private equity. That's the spurious transient persistence between the fund N and fund N plus 1, because they are staggered, they overlap in years, for several years, so there may be some overlapping investments that just mechanically creates persistence, but it's transient. And again, it's not going to be very investable. So they find that indeed there is skill in private equity. So there is high long-run persistent differences in expected returns of 7 to 8% between the top and bottom quartile fund managers. But at the same time, performance does contain a lot of noise, and half of autocorrelation across funds is spurious in nature, so it leaves little investable persistence, especially for VC funds. You have to have a very long history to do Bayesian update to get precise enough information to have investable persistence. And what they find is they need something like 25 sequence of funds, and very few VC firms have 25 funds. So I like this paper very much because they're always very good at introducing more sophisticated method to private equity. And in this case, the hierarchical linear model improves upon the existing AR model to test presence of cross-sectional persistence. And they provide 2 subtle but very important insights. One is that presence of luck doesn't imply that there is no skill differential. You can still have skill differential. Second is that long-run persistence doesn't necessarily guarantee investable persistence that investors can actually act upon. So I think these are both important insights that they bring to the literature. Their findings also explain, additionally, the puzzle of rent sharing between fund managers and limited partners in private equity. Unlike the Burke and Green assertion that the fund managers with skill should extract all the rent, there seems to be some rent sharing. In here, what they explain is that to identify GPs with skill, investors also have to be skilled, and skilled LPs are very scarce. And therefore, those scarce LPs who can disentangle the noise of luck from true long-run performance, persistence due to skill, they can earn rent. They also tell us that past performance is not a very precise indicator of long-run persistence, so it's rational for investors not to be too sensitive, not to respond with high sensitivity to the performance. So, almost done, yes. So, I just talked about 2 papers, but if I whet your appetite in private equity research, and if you want to hear more about it, I'm going to be talking more about this in the overview and research lecture that I'm providing on Friday, 8:30 to 10 at Wellesley. So please come or watch the video afterwards. And so I think that's pretty much all I have for the research in private equity and venture capital. And if I'm out of time, I can leave the talk about, it's up to you.
We can follow up on that in the
During the
discussion.
30-minute discussion. So let me skip on that. Some of the points others have already touched on. So let me conclude. The private equity is now a major segment of asset management industry. Still many unanswered questions, and there is greater demand for knowledge from investors and policymakers alike. There are many ways to advance the literature. Novel data, novel method, and cross-pollination with other fields are all fruitful ways to go. So it is a rewarding research area for young people to build their careers in, and I hope to have more and more young people come to this area. Thank you.
Thank you so much.